Well, how's it, everybody? It's the 8th of February. If you are Chinese, which I don't think too many of our tribe are, because we don't really have an outpost in China. But if you were Chinese, you would know that the 8th is a very lucky day, because number 8 is the luckiest number that there is, according to the Chinese anyway. And you perhaps could be getting very lucky today, because this is 12J resuscitated. You'll remember Stu, my good friend and colleague, Stuart Lohman, and I spent a lot of time a few years ago with the gentlemen who are on screen, or certainly with John T. and Dion, and I'll introduce them properly in a moment, where we explained, or they explained, we facilitated the 12J project. Unfortunately, some idiots in Pretoria decided that 12J was a bad idea after it had taken so long to catch on. But fortunately, very fortunately, the government has realized that by bringing the private sector in, we're going to get this energy crisis sorted in South Africa. And so there is a 12J successor, which we'll be hearing a whole lot more about now. Unlike with 12J, which was 100% tax incentive, this is 125% tax incentive. So it shows you a little bit about the urgency of all of this. So, Stu, that was 2 years ago, hey, the 12J stories.
Yes, 2021, if I'm correct, Alec. John T might have the exact date, but yeah.
John T, it's
end of June 2021, yeah.
Yeah.
Okay, so it'll be 3 years of June, sure. Well, it's sad that that's gone, but the tribe members who invested, they are very, very happy. They've made a fantastic return. But if anything, the 125% is even better. John T, we're going to talk to you second. We're going to kick off today with Dion and James, Dion Lewis, James Rossman, and we will, John T. Sachs, of course, is from Geltec, and we will be giving them each about 7 or 8 minutes to just go through their offering so that you understand more. But the whole intention here is to have an interactive webinar. We all learn so much more when we get to ask our questions, and I'll be facilitating those questions, but Stu is going to make sure that all the tech is right. Stu?
Excellent, thanks, Alec. Yes, just quickly, on that control panel on the bottom of your screen, there's a high five option. It's called raise hand. If you can see Alec and myself and the 3 others on the screen and hear my voice clearly, please give us a high five. There you go, Alec. Simple, simple. And as Alec mentioned, it is to keep this conversational. So on that same control panel, there's a little questions option. That's called Q&A. If you please put your questions in there, Alec can pass them on. But all good on the tech side, Alec?
Magic. And on Q&A, just type your questions in. I will keep that box open on my computer, so I'll be watching it all the time. But Dion and James, we had a webinar a few weeks ago, and I learned a heck of a lot there. I presume that you've still got a little bit of scope available, otherwise we wouldn't be having this webinar now. How close are you now to filling up?
Yeah, thank you, Alec. It's always good to be with you guys and talk to your community. I think this slide sort of speaks for itself. When we last spoke, we had 39 million left in this fund. As of today, it's 9 million. So it's been an interesting and busy 2-3 weeks behind us. And again, it just emphasizes the urgency of investors to talk to us and make a decision as soon as possible to get in.
Before I leave you to carry on with your presentation, could you, and before you go into it, could you just give us an understanding of how you deal with people? I know when people are going to then email or maybe phone you, I think you had your cell phone numbers up at the last webinar. Do you then have like individual consults?
Yeah, Alex, so we had a few people that contacted us directly after the last webinar, and obviously we don't mind that. But the correct process would be for them to go onto the BizNews website, fill in the form, We get those requests, and we will immediately make contact. One of the team members will make contact with the investor. Some of them ask us not to phone them. Then we'll engage with them on email. But there's a process that then follows. I mean, obviously, we need to understand, a few metrics and parameters around the particular investor scenario. And based on that, we give them almost like a personal type investment report, which is the foundation of our discussion. And then we tailor the solution, for them. And if I say tailor, I mean find the correct investment size for the best potential tax deduction and return for that particular investor scenario, taking into account the effective tax rate.
Magic. Thanks, Dion. Okay, over to you, sir. I will switch my video off.
Thank you. So I think the most important element about what we offer here is the fact that we're doing it slightly different from the rest of the market. Everybody asks us, why are we so late to the 12B party? And it's very simple. We decided to find the assets first, construct them, and then raise the 12B capital. So that will ensure that the investor will get their 125% deduction in the current tax year, the 2024 tax year. And also keeping in mind that these assets that we busy constructing, most of them are already finished, are new generation assets. So it will give investors the additional 25% deduction for this year, and then if they invest in the next tax year, the next year, versus 100% if it's not a new generation asset.
Yeah.
James,
Cool.
if you want to take us through the first 3 projects.
Yeah, thanks, Dion. I think a picture paints 4,000 solar panels better than words. So yeah, our first project that we're looking at here is our pride in the Western Cape, called Groenvlei. Groenvlei is situated just outside of Wellington, and it's a 313 kilowatt peak solar plant. And Dion, if you go to the next slide, you'll also see the battery that's there. That's a 645 kilowatt hour battery, and that Dole system went live on the 15th of January, and it's already producing electricity. And yeah, it's a long-standing family farm. They're really running a solid business there. Then yeah, if we move on to the next slide, it's a farm called Toornekraal. It's also in the agri space, and really what we have there is a 77 kilowatt solar system with 120 kilowatt hour batteries. And it's also already delivering power, and we're getting really great feedback from the farmer there. And it's also a multi-million rand operation. So yeah, credit risk there is quite good. And then lastly, our last project in the Western Cape is Stilbaai. So that's a retirement home in Stilbaai, also here in the Western Cape. And we're sporting a 113 kilowatt peak system and a 120 kilowatt hour battery. And yeah, Stilbaai is managed by one of the biggest non-profit organizations in South Africa, and they get government subsidies, and they have reserves. So yeah, from a credit perspective, we're also quite happy with what we have there. Yeah.
And then the last project in the current portfolio that we're raising capital for now is a project called Nicolor. It's a gold processing plant. It's not a mine, and I want to make that distinguished very clearly. And the advantage of that is that the raw material that this plant reworks to refine the gold is from external sources. So there's various suppliers that raw material is sourced from, and it's not a mine. So it's a 10 megawatt peak demand processing plant. We're installing currently 4 megawatts, and we'll take it up to probably between 6 and 8 megawatt maximum. So the significance of that is that although the mine's peak demand is 10 megawatts, and we will be installing 4 to 8, it means that they will use all the energy that take or pay arrangement or contract. The go live date for this plant is the 16th of February. And these photographs that I'm showing you here were taken earlier this week and last week. And the key differentiator, we believe, and strong point about this particular plant, and considering the fact that it's almost 60% of this portfolio, is the fact that we've designed this plant and implemented technology in the phase 1 of this rollout to get this plant wheeling ready. Now, wheeling means it's a mechanism that you can sell electricity to other off-takers in the area or on the Eskom grid. So, and the significance here is the fact that if Nicolor as the processing plant fails, in other words, the off-taker is not in a position to buy your energy anymore, we can sell that energy to other off-takers in the area or on the Eskom grid. So it's a key risk mitigating strategy for us.
All right. Yeah, and Dion, I think, yeah, if we look at the investments, we've sat through countless calls over the last couple of weeks, and it's sometimes a little bit difficult for the investors to get their heads around like the gearing mechanism that we have in. So I thought it like good to first look at our projects without gearing, and then on the right hand side we look at it with gearing. So on a R1 million investment in our projects without any gearing or 12BA, we're looking at R1 million, obviously, that you have to spend to buy it, and you'll get R1 million 12B allowance, which would mean a 450,000 rand tax saving. And that R1 million asset will then generate close to, call it 2.9 million rand in pre-tax cash flows over the next 25 years. And that leaves us with a return of about 22% before tax or 12% after tax. But now what we've done is we've essentially arranged a low gearing component in the fund that will actually enhance the return. So essentially what we're sitting with here is your R1 million investment as the investor, and we add 520,000 rand in debt, and we buy a solar asset of 1.5 odd million, which for a 45% taxpayer means 850,000 rand tax saving via Section 12BA. And essentially what that means is SARS is covering 85% of your investment, and you're only really left with 150,000 rand at risk. So that 1.5 million rand asset then generates about 3.3 million rand in free cash flows over the next 25 years, and we're projecting a pre-tax return of 35% or 18% after you settle the taxes. I think also the important thing to notice here is that the investment horizon is 25 years, but some investors would like to exit earlier. So we're planning on offering an exit option in year 7, where we essentially sell the investors that wants to exit will sell their assets or refinance. But yeah, we really like to stay in for the full 25 years because the sweet spot really it's after 10 years once the majority of the debt has been settled. There's also, just because of Section 12B and the gearing, we're essentially adding another 400 or 40% savings that the investors get in year 1. Dion, and then if we go to the next slide, I think it's also important just to give you a quick note on the risk of the debt. So I think the important part here is we've got our debt covered by threefold. So even in the worst case, if something bad happens to one of the big projects, even if we can't implement the mitigating strategy like Dion mentioned with wheeling, there's more than enough assets to actually cover the debt in a worst case scenario. So what we have here is solid tangible assets, and we're keeping the real risk very, very low.
Now, if I can add to that, you'll notice on this graph, that red line, there's a distinct dip between year 0 and year 2. So a big component of the debt is settled early in the first year. And what is important here is that the returns, the cash returns to investors in the first 10 years will be a little bit lower if you compare it to an ungeared investment because of the debt that's been settled out of cash flow of the project. So keep that in mind when you do look at the numbers. But the mitigating or the upside of this is that because you're getting the additional 29% upfront that SARS funds, you're effectively taking those yields out of the first 10 years and you're bringing it forward into year 1, funded by SARS, effectively de-risking your investment up to 85% should you be on a 45% tax bracket. Yeah, and the conclusion slide is just on the fees. So the upfront capital raise fee is 2.5%, which translates into 1.6% of assets under management, and that's not paid by the investor. It's paid out of the project. The management fees, the annual management fees, is 1.87%, which translates to 1.25% of assets under management. And then we only take a performance fee after year 10, and that's 20% of the profits. And that's it.
Yeah, short and sweet. Thank you very much. We've got 8 questions already, Dion. So there's lots of that is going to come through in a moment. Just to remind you, when it comes to questions, I will only identify you by your first name. So I know there's anonymity issues whenever you talk about tax, but in this case, you don't have to worry about that. I will not give your full name when I say who the question's from, but just your first name. Thank you to Dion and James. Let's give the floor now to Jonty. Jonty, you guys have done really well. I mean, I can't let you go without, or let this go without just mentioning how the whole crypto story it's rebounded, and we've had a lot of the business community who've invested with you in your offerings there, including us ourselves at BizNews. It's lovely to see how that has improved over the last little while. So good luck on that one. Now, you work with a bunch of actuaries. Dion and James are chartered accountants. So we've got the guys who know the numbers real well. And clearly, it's not a surprise that Geltec would also see some very interesting opportunities for members of the business community in this area. The floor is yours now, sir.
Thank you very much, Alec. Thank you. Yeah, and to everyone, I think, just to Alec's point, our business is alternative investing. So historically, Section 12J, we raised 1.7 billion rand. We've got a cryptocurrency services, which we've got a lot of money of investors, particularly business community with us, and it's doing really nicely. But as with the crypto market, it's always up and down. And then with Section 12B, it's not anything new to us. This is the third fund that we're raising in this financial year. Our first 2 funds were completely oversubscribed, and we've pretty much fully invested all that capital. With debt, we've raised just under 500 million rand, and all our equity is already invested into projects. And our June fund is effectively 100% fully invested. Our September fund, we're going to achieve between 80 and 90%, and those investors will get largely 125% tax deduction. So we're really thrilled and proud that we've deployed such a vast amount of capital during the financial year, and it's really because we've got an enormous team. Just in the solar division, there are 11 of us, of which they're actuaries, they're CAs, and we've got 2 full-time lawyers, and all they do all day is do what they do best, and that's legal agreements. And in this line of business, the legal aspect is really enormous. So we've got a really, really solid team. For today's investment, we are focusing at, let me just share my slides with you. I assume everyone can see that. What we're sharing with you is, sorry, there we go, is we've got a portfolio of over 50 solar assets. This is an existing portfolio. One of the solar developers that we finance, and we're financing them into the next financial year, they build up portfolios of solar assets, and then at a certain point in time, they sell them on. And we're looking to buy this portfolio. It's over 50 assets. The beauty of an existing portfolio is you have a track record. So these assets have a track record of performance in terms of producing electricity, and they have a track record of payment. So we've reviewed this entire portfolio in terms of the reliability of the energy consumer to pay, and we're very comfortable. The track record is really, really impeccable. And what's beautiful about this is diversification. So investors who invest with us, they're getting really diverse exposure. And on the screen, you'll see 37% of the assets are in education, mostly schools. 31% is in housing, retirement villages. 15% is retail, and we're talking large shopping centers like spas, etc. and 15% is in agriculture, and that's really around pack houses. And what I'll touch on in a few moments is what you'll notice about all these businesses is that they need energy in the day. And that's a key element when I talk about the upside of potential that this fund has. So what I'm sharing with you now on this slide is what we call our base case return. So if we look at the current cash flows that these projects will produce over the next 10 years for us, and these are the type of returns. There's not many assumptions in here other than that the end customer pays, as they have been paying for a number of years, and that the assets perform, and there are guarantees in place from manufacturers. The solar developer is not going anywhere. He's carrying on, or they're carrying on to maintain these assets for the foreseeable future. So what you're seeing here is an investor gives us R1 million. In this financial year, they get a tax benefit of 450,000 Rand. This is at 100% tax deduction because we're buying existing assets. We don't feel that there's enough time to build new assets to get investors 125% tax deduction in this financial year. We've signed deals in the next financial year of over 90 million Rand, but there's just no time. So, if investors want a tax benefit in this financial year, one of the lowest risk ways of doing that is to invest with us in a fund where these assets are already producing. So investing gives us R1 million. If they're in the highest tax bracket, they get 450,000 Rand. And then every year thereafter, they get cash flows. And these cash flows are really based on how the systems are currently performing and payments received. And what you'll notice here at year 6 is if you add up all the cash flows and the refund, the investors got all their money back. And then the assets continue to perform. And then in year 10, you'll see a really large sum that's payable to our investors. And that's because there's still 7 years left after the 10th year of the asset. These are 17-year contracts. Now, what's very common in the market is asset rental businesses or asset-backed businesses. They sell their future cash flow to the big banks. It's a very common business. And there's a simple methodology in valuing it. And based on our valuation and really how the market perceives it, is investors should receive around 852,000 Rand at the end, which is taxed as income tax. Now, this number, we don't think is inflated. As a fund manager, we earn a performance fee, and we incentivize to ensure that these returns are achieved, or we don't earn a performance fee. So we incentivize to sell the assets at the end for the highest price. So if you look at the last 2 lines, these are in the base case scenario returns. And I'll take you to the next slide to give you a better understanding of the potential upside. But at the base case, we're looking at a 20% annual return after fees with tax, so pre-tax and with a tax benefit. So you need to compare this 20% to if you deposited money with Investec, as an example. If you deposited money and you received a 9% return, that's pre-tax. So you need to compare 9% to a 20% return here. Obviously, those are different types of investments with different risk profiles, but just important to you to be able to do a like-for-like comparison. And if you take off the tax with a tax benefit, that's an annual return of 8%. So I would agree, this isn't private equity-like returns, venture capital-like returns. This investment isn't in that risk profile. Stable returns, contract-backed returns. There's a solid asset here, which should continue to yield really nicely in the foreseeable future. So this is our base case scenario, where there's a real opportunity to build upside for investors. Is almost all the assets that we're acquiring don't have batteries. Now, what this means for the energy consumers is if there's load shedding, if all you have is solar panels on your roof and an inverter, if there's load shedding, and this will sound counterintuitive, if there's load shedding, you don't have electricity. A solar system needs a battery, a generator, or some form of electricity supply in order for the panels to work. So if you've got panels on your roof and there's load shedding, you're not going to have electricity unless you have a battery. So the businesses that I mentioned earlier, they don't have batteries. So when there's load shedding, the school lights turn off, the spas, fridges turn off, and the farms stop packing. So batteries for them would be really a no-brainer for their business. So what we will look to do is finance batteries into these systems. And in order to do that, we'd need to raise some debt from the banks. which we have really strong relationships with already. So if we are able to raise the debt and convince only half of the businesses to take up batteries, these are the type of returns investors can anticipate. But something I haven't mentioned is when we finance the batteries, our investors get a second tax benefit in the next financial year. So from 1 March, in the 1 March financial year, investors get a second tax benefit because we're buying more solar equipment and investors are getting 125% tax deduction. This may be a lot to absorb. My details will be at the end of my presentation, and I'm happy to sit with anyone and explain it in more detail. So this is how the numbers work. You invest $1 million with us, you get a 450,000 Rand tax benefit if you're in the highest tax bracket. You receive some income in year 1, but in year 2, you're receiving a second tax benefit of 289,000 Rand if you're in the highest tax bracket. And then you continue to earn income. And if you add up all those incomes, within year 4, you've received your money back pre-tax. So you're effectively de-risked, you're exited, but you're still generating returns for the years to come. In year 10, the same principle applies. We'll sell the future cash flows and investors will get a nice lump sum at the end. But if you look at the bottom of the page, the last 2 lines, earlier I showed you a 20% return. Here it's 30% because of the additional batteries. Earlier I showed you an 8% after tax with a tax benefit return of 8%, and now it's 14%. So it's significantly higher returns. And we think that this is really possible. There are no guarantees that we can raise the debt or deploy the batteries, but we think that it makes business sense for all the property owners. Here are my details. What I haven't discussed is fees. Our fees are 2.25% per year, which is lower than our 12J fees. And we charge a performance fee of 20% above a hurdle of 9% with a high watermark and catch up. And what I mean by that is if our hurdle is 9%, if we only return 11%, we make 20% on 2%. If we return below our hurdle, in the following years, we need to catch up that return in order to earn a performance fee. Alec, that's me. Alec, you are on mute.
I wanted to be mute in case I coughed during your presentation, and that would not have been clever. My apologies. Okay, well, we've got many questions to answer. I'm going to kick off with one from an anonymous person who wants to know, very simple, can companies get involved or is it just for individuals? And I think the way to handle this, guys, let's go 1 Futureneers, 1 Geltec. 1 Futureneers, 1 Geltec. Unless you don't know, and then you can always pass the ball. So over to you guys first, James and Dion.
Okay, so if I can answer that. So this particular product does not suit a company investment because of the tax rate of 27%. It works best for investors in a tax bracket of 41% or higher, unfortunately. But as we said in the previous podcast, there is a good chance that we will be launching a new product next week that will cater for investors with a lower tax rate, including companies.
And Jonty, on your side?
Yeah, companies can invest, and Dion's 100% right. They benefit less because of their tax benefit, their tax rate. But what we often see is if it's an entrepreneur-owned business, instead of the business investing, rather pay himself a nice bonus and then invest the bonus, because the bonus will attract 45% tax. And if you invest in a 12B, you're getting 125% of that, then it makes sense. But if it's not an owner-run business, then wouldn't be as attractive.
Andre wants to know, can an investor get the tax benefit with this even if they've installed solar already this tax year?
It's really it doesn't relate. So in investors who, maybe you own a home and you've installed solar, it's unrelated to this. This is as an investor who's looking to invest for the purposes of shielding tax and getting a return, it's applicable. So if you've installed solar and you want to invest, not a problem, but they're unrelated.
Anna Marie asks, Dion, maybe you and James can pick this up. Any clarity when the definition, what the definition of a solar asset is? Does it include inverters and batteries?
James, you can
Yes.
take it.
So maybe I can take that one. Alec, Anna-Marie, yeah, absolutely. There was a ruling by SARS done in December 2022 that clarified this for all of us quite a bit. And it's all the assets that would assist in generating electricity. So as John T also explained, a battery actually helps you to generate electricity during the load shedding period. So yeah, you can absolutely claim the tax deduction on the solar panels itself, the batteries, the inverters. So anything that assists in generating that renewable energies. And yeah, but I think sometimes the confusion comes in on the residential solar deduction that John T referred to earlier. That's section 6 or something. That is purely on solar panels for individuals in their own capacity. And not for batteries and inverters, but on section 12B, if it's generating renewable electricity, you can claim the tax deduction.
Here's one that I think many are thinking about. Can an assessed loss created in 2024, also from an anonymous attendee, be carried forward to 2025?
So we've got a tax opinion on this subject during the section 12J days. So if someone invested more than their taxable income, they would go into assessed loss. I've had this discussion with a tax professional, and they've confirmed that in terms of section 12B, you can go into an assessed loss. I don't have an opinion. It's not necessary for us in our business. So I can tell you my personal view is yes, but I would seek professional advice before doing so.
Yeah.
Any thoughts on that one, James?
Yeah, so if I can just maybe add on to that, it's not necessarily totally advisable to create an assessed loss, although I agree with John T that you can do it. The real reason being for that's the benefit that you get is obviously more on like 45%. So if you create a tax loss, you're actually getting a benefit of only, for argument's sake, 18% on the last 300,000 Rand that you invest. And then you also have to be careful in terms of like ring fencing, because if you make a loss in a business such as this, because it's essentially a business that you're running now, and there's losses for 3 consecutive years, SARS might actually come back and say, look, you're running a business that we're going to ring fence. So, but yeah, in this case, with what we and Jaltec are doing, you're essentially making a big loss in year 1 because of the 12B benefit or 12BA benefit. And then you're making profits from year 1. So that's why it won't be ring fenced.
Anthony was quick off the mark, and he's got, well, a question in 4 parts. How does the tax deduction work for 12Bs? A, do you deduct the full 100% invested against taxable income? B, or is the Rand amount deduction limited? C, when does the 125% deduction apply? And sorry, it's only C. Those are the 3. So perhaps you could pick that up, Dion.
Yeah, if I can take that, and then John, you could probably add to that. So let's take a R1 million example, and the investor being on a 45% tax bracket. So you invest R1 million, it's on a new generating asset. So it will attract the 125% deduction. So it means it's R1 million times 125 times 45%. That is the actual Rand value that SARS will rebate. If you're looking at the deduction and you want to isolate the deduction amount, it's R1 million times 125, which is then 1.25 million Rand deduction off your salary. If you bring debt into the element or into the project, R1 million investment, let's say for example, 500,000 Rand debt, it's 1.5 million Rand worth of assets that you'll show on your balance sheet, times 125% times 45%. And that's how you get to the 85% rebate from SARS instead of, for example, 56% if there's no debt.
So just listening again, and maybe for clarity, the way I understand it is with future years, how you're gearing up or you're leveraging the return is through debt. With Jaltec, how you're leveraging the return is through adding batteries into the future. Is that right? Am I reading this correctly?
I think both companies are offering the debt. It's just the timing difference. So Futureneers is doing it in this financial year. We're doing it in the following financial year. We're using the debt to finance additional batteries, where they're using the debt to build their assets or to buy their assets.
And
Okay.
Alec, it's also quite interesting to note, and it wasn't because we were colluding or anything, but our debt to asset ratios coincidentally exactly the same as what John T and them are planning at Geltec. So yeah.
Okay, let's keep going. Anna Marie's got another question. Sure, she's got a couple of questions here. The warranty periods on panels, etc., are 10 years. How do you marry this risk to a 25-year proposed investment period? I think it's probably for you, John, because you were talking 25 years.
So panels are actually 20 years. Sometimes they're even 25 years. So the key there is obviously only to buy top tier panels. But your question is very relevant when we look at batteries. So batteries typically have a life cycle of around 10 years, and then their production starts to drop materially. So as a business, what we do is we finance batteries over 10 years, and we finance the panels over 20. So the payment profile of our financing or funding is one where the batteries are paid off within 10 years, so we don't take that risk. And then as soon as the warranties drop off, we've paid it off, and then the panels carry on under their warranties. So there's a real key timing component which we really focus on. So in our instance, the panels will be under warranty for the full term.
Quite sophisticated, quite complex.
Add to that, if I can just add to that, Alec, what needs to be noted here is that inverters, for example, if you're looking at a 20-year PPA, won't last that long. So what all of us do, including Geltec, we would work in the capital to replace those inverters typically from year 8, 9, 10, 11 onwards. So that's all worked into the numbers.
Yeah, my point there was that this is complex, and you've got the experts on your side in this case, and it might be counterintuitive in certain instances, but you are always focused on getting the best return for investors. Johan wants to know, maybe Dion, you could respond to this. Does the after-tax return depend on your personal tax rate?
Yes, there's a direct correlation between your tax rate and the ultimate return that the investment will give you. So yeah, talk to us and we'll work it out for you exactly what it will be.
David wants to know, how can I get the recorded presentation to discuss with my auditor? Stu, do you want to answer that quickly?
Thanks, Alec. We will make the presentation available on YouTube, hopefully as soon as possible after the end of the webinar, Alec, and the same link will be sent to all people who've attended the webinar, so it'll be accessible to all.
Very happy that we've now got Zoom as our service provider, because it enables us to do those kind of things. Alan wants to know, what's the minimum investment you would consider in order to get one's feet wet in this? And well, I guess both parties need to answer that one. John, do you want to start?
Yeah, ours is 500,000, right?
Yep. Thank you, John T. So in the first webinar, we said R1 million. We decided to bring that down to 500 purely for the fact that the deduction is so huge. If you factor in the debt component, you need less capital to invest to ultimately get a big enough deduction. So 500 is the same.
Okay, and there's nothing less than 500. If Alan says he wants to get his feet wet with 100,000, sorry. Not. Sorry, Alan, but I'm sure you're talking at 500,000. It's quite.
If I can just say why, and that's because the limitations around how many investors you can have in a partnership, and we've taken a conservative view that you need to be less than 100. So, if we can't have 1,000 people in this investment, it has to be restricted.
Jonty, you mentioned the 100%, not the 125% tax benefit as the project is existing. An anonymous attendee wants to know, can you just explain that, please?
Yeah. So for our earlier investors who invested in June and September, we were able to offer them a 125% tax deduction because because there was enough time to invest, to find projects, due diligence them, invest in them, and then see them get built. We've had a number of projects, and if they're not built by the end of the financial year and producing electricity, you don't get your tax benefit. Your tax benefit will roll over to the following year if and when the systems are live. So what we don't want to do is offer an investment, lead investors on to believe they're going to get 125% tax deduction, and then come the end of February and say, sorry, we just missed the deadline. So we've put all our new builds on hold until early March. Around 90 million rand we'll start getting built in March, and we're looking at existing assets, because these portfolios they're live. As soon as we pay for them, they're ours. Our investors immediately get the tax benefit, but it's at 100%, and that's really because it's late in the financial year. If someone wanted 125%, then they need to have invested earlier in the year with us, and our next fundraise will start on the 1st of March.
Robert wants to know the relationship between Geltec and Futureneers. The relationship is that they are both business partners of BizNews. That's the only relationship, and we like to give our community options. So I guess where we would come from is to say, invest with both, but we'd like to give you, as we did with 12J, if you remember. Stu, how many guys? I think there were 5 options. Is that right?
Yes, 12... we had 5 options in the 12J, Alec.
Yeah, and so we have 2 options here, and both, by the way, of these business partners were partners of ours in 12J, and we've only had big thumbs up on the performance and the service levels, and of course the returns that have been achieved during 12J. So that's the reason. So there is no relationship between the 2 of them, unless you guys have been doing something recently that I didn't know about, Dion.
There's only one relationship. We're competing.
There we go. Okay.
If I could add is what Dion and I and James and Yaku, Dion's other partner, have is a good relationship. So, although we're competitors, we speak every now and then, and I have a high regard for them and their business. So, I wouldn't want to be on a webinar with someone who I, thought that they were not honest and decent human beings. So there's a very good relationship here.
Yeah, I think it would be very difficult for BizNews to host a webinar like that as well, as you can imagine. Robert also asks, get 100% benefit in 2024 and an additional 25% in 2025, Jonty?
An additional 125% on the debt portion. So you invest $1 million with us, you get 100% tax deduction in this year. In the next financial year, you'll get 125% tax deduction on half your investment value, which will be the debt portion.
Anthony, he says, most of my questions were answered in the presentation, but could we maybe dive into my third question, which is the 12B deduction not applicable to the actual company who installs the solar power at their own facilities, i.e. Anglo American put solar up on their own mine? If so, how does a PDY Limited like Geltec get around this when they install solar at several different companies or users' premises?
Yeah, I'm happy to take that question on. So what the tax legislation says is that a taxpayer that, and I'll just use simple language, where a taxpayer invests in solar for the purposes of generating an income. Now that reference to generating an income is relevant because where a taxpayer does that, they're entitled to Section 12B. So Anglo America, they are investing in solar to generate income. They need to mine, process minerals, and they get the 12B. In our scenario, we have a partnership structure, or call it an investment vehicle, which intention is to buy solar to sell electricity to an end consumer. So our intention is to generate an income from the sale of electricity, and as a result, our individual investors get the tax benefit. Now, this isn't a clever scheme, crafted by ourselves and Dion. It's in the tax legislation. There's SARS rulings online, which affirms the structure. So this isn't something racy. This is just how the legislation has been drafted.
But I think where Anthony's going, and I'd also like clarity on this, maybe Dion, you can help. Is there not a double deduction coming here? Because your gold processing plant, their investment presumably they would also want to get a 12B deduction, whereas the investors that go through future years to make that investment will clearly, in this case, get a 12B deduction. So how does that work? Do you get, both of you get it?
James, if you want to take that.
Yeah, sure. Like, so yeah, essentially because the investors in our case, or in Jaltec's case, they're putting up the funding, and they own the assets and they're selling the electricity. The person that owns the asset gets to get the tax deduction. So because we're selling electricity to that mine processing plant, they're not actually putting up the money to install that solar. Our investors would be putting up the money, and that's why they get the deduction. So there won't be any double dipping in SARS's coffers, essentially.
Very simple. Thank you. Thanks for explaining that. Bruce asks, when they are considering adding batteries, have they had an engineering assessment of the technical feasibility? It is easy to add grid-tied solar panels to carry partial load, but batteries mean the inverters need to carry the total load in the event of load shedding, or some sort of automatic changeover switch will be required. And hybrid inverters are required as far as I know. Jonty, I think that's for you.
Yeah, so most installations, commercial installations, are they use hybrid inverters for that exact reason, to add on batteries. So in our instance, this is not a technical concern of ours, and we're very comfortable that all the systems can take on batteries. But you are right. If that wasn't the case, we'd need to then get new inverters, and potentially the cost would go even higher. But that isn't a risk for us.
If I can add to that, Alec, I just want to make a distinction. For example, in Nicolor, the gold processing plant, which consists almost 60% of our portfolio, in that particular case, they don't get load shedding because they're on a certain part of the grid with all the other mining operations on the same grid section. What they do get is tailing of energy use. So as I mentioned earlier, the peak demand profile is, for example, 10 megawatts. Eskom will curtail them to, for example, 8. So therefore, they don't get load shedding. And in that case, it's a grid-tied solution where the inverters and all the technology specifically spec'd and designed to be a grid-tied solution and not necessarily use batteries.
Thanks for that clarity. Doug wants to know, if an investor sells after a few years, is there a tax event?
Yeah, I can maybe take that one. So absolutely, there would be a recoupment. So I think from a Section 12BA perspective, if you're getting the 125% tax deduction and you sell within the next 2 years, you'd actually get recouped on the full 125%. But if you sell after that, there will only be 100% recoupment. But that 100% recoupment will always be there. So if you bought solar assets for R1 million and you sell them for R1 million again, you would have to pay back at the full tax benefit that you got in the first place.
But if I could just add, Alec, on both scenarios, what we are showing and what Jonty and them are showing, the after-tax numbers that we're showing takes into account when that should happen. So just keep that in mind.
Andre makes the point here that the 45% tax bracket starts at 1.8 million rand or 150,000 rand per month. So, but I know there are a lot of our community who are looking at that. He says, so the tax break won't work at a flat 45% if you're in that bracket, or do they look at the average tax rate?
So, Alec, how it works is, so let's say, and I don't know the tax brackets off the top of my head. I hope I never know them. So if someone earns 2 million rand a year, and let's say the first bracket starts at 1.8 million, someone earns 2 million rand and they invest 300,000, that'll take their taxable income to below the 1.8. So they would have paid tax at 45% above the 1.8, and they would have gotten a really nice tax benefit. And then as you go down, as you invest more, it starts squeezing your tax bracket. But what mustn't be understated is, let's assume your tax bracket is 30%. If you're getting 125% at 30%, it's obviously pushing that 30% up significantly. You're getting a nice, you're getting a higher refund as a result. But the maths that we all have shown and disclosed is that it's assuming the investor is in the highest tax bracket.
An anonymous question: what documentation is required for SARS? Will you provide it?
Very good question, James. I think take that one.
Yeah, so like essentially, because you're in a partnership, we have a full guide that we also can provide with the investors too. So there's obviously 2 different tax return types that you have to do. The first one being the provisional tax submission that's due before the end of February now, and then your tax submission that when tax season opens up in July. So yeah, we provide you with all the documentation that you need. It's essentially the partnership's financials. So you'd get a set of financial statements, and then on e-filing at SARS, they will ask you the questions, are you a partner in any partnerships? And you click yes, and then they give you the details that you need to fill in, and we'll provide that to you.
A similar question from the same community member is, what's the difference between Section 12B and Section 12BA?
Section 12B B without the A, so just the B, is the old legislation and really gives an investor 100% tax deduction. 12BA is the new legislation which gives the investor 125% tax deduction, and that's limited for 2 years. So this financial year and the next financial year. After that, we assume it'll revert back to 100%, or who knows, maybe they'll extend it, but that's the key difference.
The 9 million rand still available. Is that Geltec and or Futureneers? Maybe you should, both of you should just outline exactly what is still available in your different portfolios before the end of the of this month, because that's the end of the tax year. Jonty?
We are raising 100 million. We launched the fund last week. We offered to our existing investors first, and they've taken up 75% of that. So we've got 25 million rand available.
So we've started 3 weeks ago. We were raising 39 million, and there's 9 million left in our fund.
Okay, so it's 9 million left with Futureneers, 25 million left with Geltec. Nice clarity. What is my source document that I will receive to show ownership? That's from Marina.
Yeah. So, Alec, Marina, essentially your source document would be the partnership agreement that you will sign, and obviously the financial statements of that partnership. So the combination of that too.
Trevor's got a couple of questions here. If one deducts the investment plus debt at 125%, balance sheet is mentioned, but this is an income deduction upfront for the February 2024 year. What is the view for PAY taxpayers, even if provisional or with smaller income, where this would be a large refund from SARS? How is it treated by SARS, and if the tax has already been received by SARS? I'm in that boat. I'll pay a lot of tax every month. Is SARS going to give me money back?
Yeah, so typically how it works is, so for provisional taxpayers, the proposition is really outstanding. Before the end of the month, you make an investment, and you make in your submission, on your provisional submission, you made a Section 12B benefit, and that immediately reduces your taxable income, and it immediately reduces how much you need to pay SARS. So if you invest $1 million and you with us, and you're entitled to 450,000 rand reduction in your tax, you'll literally not pay 450,000 rand. If you are a PAYE payer, in other words, every month your company deducts your tax, and come the end of Feb, you make an investment. When you do your submission in July, from July till, let's say, August, September, you should then receive an actual refund from SARS. And I can tell you, I've invested in, I think, every single Section 12J fund and Section 12B funds, and I've received my refunds from SARS. So, we've had, I think, one investor out of 1,300 who had an issue with SARS.
If I can just add, provided, of course, all your other tax affairs are in order.
Sure. Yeah. Okay. Nice. And I suppose if you've had a bit of a problem with your provisional tax coming, the second provisional tax, where if your taxable income is going to be a heck of a lot, is going to be higher than what you'd been estimating, it makes a lot of sense so that you don't get penalized for getting that one wrong. That's happened to me once before, not very pleasant, where you have to pay additional because you didn't get your sums right. But of course, that never happens to you guys.
We try not to pay any tax.
What will I receive in 2024, asked Robert, if I invest 500,000 Rand?
James, I think you use a hypothetical example.
Yeah, so essentially on a 500,000 Rand investment in cash, on the future years product, we add another 250,000 odd in debt. So that's 750,000 Rands in solar assets that we'll buy. And then you get 125% tax deduction on that. So if you're in the 45% tax bracket, that is, if you give me a quick moment, times 45, that's 421,000 Rand in tax savings if you're in the 45% tax bracket.
That's incredible. So I give you 500,000 Rand, and SARS gives me 420,000 Rand of the tax that I've paid if I were in that tax bracket.
Yes, absolutely.
Bit of a no-brainer. I mean, but we did say that before, and I suppose that's why, Jonty, when you open this 100 million Rand fund, 75% of it gets snapped up. People who understand this, they don't sit on their hands for very long. That's obvious. The anonymous asks, what is the minimum tax threshold where investing makes sense? Nice question for both of you.
So I think we sort of answered that in the future years current product, this portfolio that we have available here now. It's 41% upwards. Jonty?
Yeah, it all depends on your personal preference. In my personal capacity, I've reduced my my tax to just below the 30%. So I'll pay tax on 30%. So that's kind of where anything above that, I want to use the tax benefit to reduce my taxable income to that amount.
And where does that kick in? What's the
I think it's 300. I think it's 360,000 Rand or 370, somewhere there is where I personally try to push my taxable income to in order to avoid paying much tax.
300,000 a year, so 30,000 a month.
Yeah. So to reduce my annual, didn't realize I'm disclosing personal information.
No,
It's okay. Reducing my annual to 360,000 Rand.
Okay.
So just for those who this doesn't make sense. So let's assume for a moment that I earn R1 million, and I would invest around 640,000 Rand, because then I'll only be taxed on the difference, which is, I think, 260,000 Rand, and that's a lawyer doing maths, which is dangerous.
Okay, and the final question, because we've got 2 minutes to finish, and I'd like you just to have a little summary. Investment with Geltech is classified as not new assets, therefore in 2024 gets 100%. Is that correct?
100%.
And Anthony's last one is future near's first possible exit is at 7 years. Is Geltech the same?
No. So our view is investors should be in this for the full term, 10-year term. Similar with our 12Js, investors went for 5, but they're human beings running this business. So if someone came to us and said, they really need the money, we can't guarantee them, but as we've done with some of our other investors, we'll sit them down and we'll come up with a plan where we help them with some liquidity if there is liquidity. So investors investing here should have the mindset of 10 years, but as I showed earlier in the upside scenario, within 4 years, they should have their money back. So effectively exited, but then they'll remain in for the rest of the term and enjoy those returns.
Yeah.
Let's close off, Dion. Your last, James, you got the floor. Your last.
I just wanted to add to what Jonty is saying. It's essentially a partnership stake. So there's nothing stopping the investors if they find a willing buyer to sell their partnership stake to someone else if they want to exit earlier.
Okay. Do you want to give us your final 1 minute summary?
Yeah, no. So I think obviously there's really just 2 bites at the 125% cherry this year and next year. So from my side, I think it's obviously a good thing we're assisting in battling that load shedding evil that we have. So by putting up new assets, you get 125% tax deduction, and we eating down load shedding. So yeah, that's me.
Yeah, and we should not underestimate that. By investing here, you're doing good, and you're supporting government in one of its initiatives that, as whatever you think of the government, you cannot criticize this one. We've got to get load shedding down. We've got to get electricity into the system if we're going to grow the economy. So thanks for reminding us about that. James, Dion, your last word?
Yeah, thank you, Alec. In the 12J days, we used to say that 12J was a gift sent from heaven. I think what we're seeing here with 12BA, and especially the 125%, it is in fact the best asset-backed tax deduction history of this country. So use the opportunity. There's only two.
And it's doing good. Let's not forget that. It's really, really doing good. Jonty, last word.
Yeah, just two small points. One is, when you look at this investment compared to others, here you're investing pre-tax. So if you give us $1 million, you're getting a return on $1 million. Where if you're looking to invest elsewhere, you won't have $1 million. You'll only have, if you're in the highest bracket, 550,000 Rand, because you would have paid a tax on your money, and you then would have been investing your net of tax capital. So this is a nice way to get a return on your tax money. And then from our side, we are looking to close the fund on the 20th of February. So if there is interest, happy to meet, ideally virtually, to take investors through the investment. But we are under time pressure, as so is, I'm sure, future years.
Stu, do you want to
Thanks,
just
Alec.
tell us where everything's going to be and how people can access Dion and James and Jonty if they are keen to get going?
Yes, thanks, Alex. So firstly, the video will be republished on YouTube. We'll put both links to each party on there. There are articles on the BizNews site. All links do go to the landing pages of both Futureneers and Geltec if needed. And then as well as that, there is an email that goes from Zoom post-webinar, which will have a link to both Geltec and Futureneers offerings, Alec. So yeah, all sorted on the link front.
Thanks again, guys, for sharing the insights and for partnering with BizNews and our community. We love bringing our community something different, something that is exceptional, and often something with a bit more complexity, that if you know it, if you understand it, then it actually becomes that proverbial no-brainer. And this is clearly one of those. I'm Alec Hogg from BizNews. Thanks for being with us today. Till the next time, cheerio.